large portion of my journey would be explained by the hunt for the Holy Grail. What is my role? Who am I supposed to represent? What am I supposed to offer? How am I supposed to offer? What is the best way to offer this to the constituents? And where should, if push comes to shove, my calling lie? Format after format, companies after companies, I was in search for a good combination of all of this. Most people at my formative years would typically like to feel confident. So when you join a brand like Citibank, HSBC, and it becomes aspirational for clients, some of the journey that we'll have to undergo in becoming valuable in the client's eyes are already solved for in the way these brands are perceived by the client. So there is a brand association that works, and at a subconscious level, it also brings in great confidence. As MBAs, they usually get exposed to formats of various businesses, quite a lot of the theoretical knowledge, and through the case studies, a lot of halfway between practical and theoretical knowledge. So that sets the stage for them to narrow down their choices and experiment. A lot of times, it is not about the designation and what they want, it is about who they are.
You were at it for 7 years. Did you raise any money, any external capital?
For this kind of innovation to sustain, the time frames of which is not known to you, you can't take public money. So I said, first, let me put my own house, literally betting the house.
So hello and welcome to another episode of The Money Talks, and today we've got somebody who has seen the evolution of wealth in India, I would say. I have known Srikanth now for almost 10 years. I think we met around the time when he had his first entrepreneurial venture. We'll talk about that in a bit, Srikanth. But it's an incredible experience to have him here, because I think if somebody can take us through this journey of an economy at $300 per capita GDP to an economy now at almost $3,000 per capita in GDP, and what the journey has been like, there can be nobody else who has more experience than Srikanth. So Srikanth, first of all, welcome to The Money Talks.
Thank you so much for having me on the show.
Yeah, and so Srikanth, I know it's taken a lot of effort to get you here, but how do you feel today?
I feel great to be able to speak to friends on a Sunday and to be able to relive nearly 2.5 decades of witnessing the financial savings space grow in this country, being a contributor to the industry and benefiting from its growth. And to be able to tell that story is a great feeling.
Absolutely, and I hope to at least take you through this journey once again and get all the learnings we can, and maybe get a little tidbits of how we can get another 100-200 basis points out of the portfolio.
Oh, that's easy.
So that getting said, Srikanth, you studied at Loyola College. Your bachelor's degree was in mathematics, physics, and statistics. And after that, you went and did your postgrad in finance and marketing. Right?
Yes, that's right.
So very, very unique combination. You were more of a scientist, I would say, more in the sciences than before getting into the commerce field. And now you're pretty much in the commerce field. But what I've always noticed about you, when you talk, you don't talk like a normal finance guy. There's a lot of calculations working in the head before you speak. So does that come from?
Yeah, the subject that I really did very well was statistics, and in my head I'm always calculating the probabilities. That's not an exact science sometimes. It combines both real numbers and sometimes gut feel too. So if you see me being busy, probably having a tape at the back of my mind, it's probably the statistics at work.
And you got out of college, I think 1998 is when you hit your professional journey. You started off with ICICI. Tata Finance, and then ICICI, and then Citibank, and your wealth management journey has now, almost 26 years in the making. When you started India's GDP, and I'll take you through the numbers with each and every very important milestones in your career, was roughly about $400 billion, probably a little bit lower than that. Per capita GDP was around $300, and this was the time when the Vajpayee government had finally got its first term in office, and we were coming off what was the Hindu growth rate of around 2 or 3% per year.
Yeah, slightly better, close to 4 maybe.
Yeah, close to 4 maybe, but in a market like that, and 7 years before was the dream budget or the time when Finance Minister Manmohan Singh had opened the economy, but no one was talking wealth. And even then, it was a very difficult market. I think the Sensex was probably in triple digits?
Yes,
possibly just 4
late
digits?
90s, probably closer to Nifty. I would remember it to be less than about 1,000, or close to 1,000.
Because when you hit up Citibank in 2002, I'll just give you the stats then. India's per capita GDP was $470. GDP was $514 billion. GDP grew 3.8% that year. And the Sensex was at about 4,000 at that time, right?
Yes.
So like I said, between 90 and 2002, no one was talking about finance, no one was talking about wealth, but you decided that this is going to be a game changer. Could you see where we are today, 26 years ago?
Honestly, no. I did want a confluence between ability to engage with clients, help them out with things that they grapple with, my interest in numbers, my interest in wealth creation opportunities. That's how the job, was an attractive field, and this seems to be distinct from the traditional banking services, traditional financial services that I was coming across. So that was the formative area that, that's how things looked at, which got my attention. I didn't think wealth management would take the shape, the size, or the form.
And the number of products today.
Yes, yes. It's back in the day. You had real estate and fixed deposits that you had to wean the clients away from. Today, you'll have to wean the client from themselves.
Yeah,
it's a significant evolution.
And I want to talk more about weaning the client away from themselves. I'm going to remember that. But your corporate experience is also I think sort of shows the progression of wealth management, because you started off with Citibank, then you were at HSBC, then Anand Rathi. You were there for 2 terms, once as a director and once as an executive director. Then you went to Motilal Oswal Wealth Management as a CEO. And after, you had a small stint in Edelweiss, again, as the head of wealth management in the external asset manager. So you've gone from your traditional MNC firms and then to, what I would call Indian Indian large corporations in the wealth space. In this entire journey, right, what was this path that you were trying to head towards?
Probably that is the most important question you may get to ask me today. Let me see if there are more. But well put. Large portion of my journey would be explained by the hunt for the Holy Grail.
Okay.
Of what is my role? Who am I supposed to represent? What am I supposed to offer? How am I supposed to offer? What is the best way to offer this to the constituents? And where should, if push comes to shove, my calling lie?
Correct.
So format after format, companies after companies, I was in search for a good combination of all of this that explains where I spend most of my energies, time, focus, and be satisfactorily delivering something. So from Indian firms to MNCs, from South to West, from broking-led firms to standalone wealth firms, I've tried all formats.
Got it.
But this was constantly having one running theme that was constant in my mind, but to an external world it may not be. It is to find that the best path to doing something great. In fiduciary services, or I would say wealth management as a semi-fiduciary services, just like being a doctor or a lawyer.
Very interestingly, unlike other wealth managers that I have met, their first conversation or the first line they start with is my AUM is. And nowhere in your mission you're talking about that my mission is to get to XYZ AUM.
AUM is the clients. I don't have anything to claim for that. I think I would like to claim for the changes in this thinking that I could bring about if it has resulted into better asset allocation, better risk management, and therefore better outcomes over a period of time. The process is what I would like to be proud of if I could contribute.
And talking about process, usually the most people usually start with some sort of an MNC brand, or they'll start off with, like an HSBC, Deutsche, and then before even they start their entrepreneurial journeys. You've done something very similar. What is the benefit of joining such brands? Like Citibank in 2002 probably preempted any other wealth management firm at that time. But what was the benefits of joining a firm like that?
Most people at my formative years would typically like to feel confident. So when you join a brand like a Citibank, HSBC, and it becomes aspirational for clients, some of the journeys that we'll have to undergo in becoming valuable in the client's eyes are already solved for in the way these brands are perceived by the client. So there is a brand association that works, and at a subconscious level, it also brings in great confidence that some of those questions were not even brought onto the table. And the journey comes from more than halfway through in terms of getting closer to the customer understanding rather than building your credibility with the customer. That's where I think brands do help.
And in terms of work ethic, is there any help? Because you join, sometimes many of the founders that I feel that come straight out of college and go straight to an entrepreneurial position, so they may not fully appreciate the kind of work ethic some of these brands put into you, right? If you work for a McKinsey or you work for Citibank for 2-3 years, they really work you to the bone, as far as I have heard. And that brings a certain level of work ethic and an intention to say, hey, 16 hours, 18 hours a day, I'm ready for it.
course. Yeah. So I would think that, by the time an MNC comes to India, it has probably spent decades uh, harnessing its business model, fine-tuning its offering, standing the test of time, standing the test of cultures that it wants to get into, and finally comes to our shores. So it's a very advanced evolution of a particular company by the time it becomes a MNC in India. So those global learnings that they will like to implement in each geography that they step into is something that you will never be able to get from a homegrown company. It was not that as this was what made me look forward to City. Like I said, it was an aspirational brand back in the day. But now when I have worked in multiple formats, I would still think that learning from at a global space of various things that they alone can get to teach you.
Like the exposure you're talking.
Yes, the exposure is what I would say is.
So we are graduating 1 million graduates a year right now in India, right? And many of them are hitting the workforce and still trying to figure out their path, right? And the next 26 years, effectively, what you have done. So what would your recommendation be to the next graduate from an IIM or ISB or even the other management schools out there? That what should they be joining first or looking for in their first role, so that they can have the kind of exposure that they need and the experience they need to be where they need to be in 25 years?
So as MBAs, they usually get exposed to formats of various businesses and get a peek in to multiple functions of businesses, multiple types of businesses, multiple stages of evolution of businesses, quite a lot of the theoretical knowledge, and through the case studies, a lot of halfway between practical and theoretical knowledge.
Correct.
So that sets the stage for them to narrow down their choices and experiment. When they get onto a corporate career, ideally I would like them to become more self-aware about who they are. A lot of times it is not about the designation and what they want. It is about who they are. Only through the first 5 to 7 years will they get to know the difference between their aspirations, who they are as an individual, what is it that they can pull off, and what is it that they think will get them motivated to last the journey for about at least 20, 30 years by the time they hang up the boots. That awareness is what I would think is the first goal youngsters can have. Second is they should, observe businesses too. They should, instead of just getting stuck in the role that will typically take a lot of their time,
Correct.
if they're observant about the business that they're in, they get to know how a business is run.
Makes sense.
Then as maturing individuals, they can say, these are the dynamics of the business, this is my role in the business, this is how I feel, where is the best confluence of all of this. That's probably by the time you're 28, 30, you get to have your formative thinking.
Correct.
Then it's now one or two choices that you will really gravitate to for the rest of your life.
So what you're saying is the intention is to, by the time you're 30 or 32,
learning,
you start figuring out which of the paths are you going to go out.
Learning through self-awareness and awareness of the business environment is what can be the goal in the formative years.
And then came the pivotal time, 2014 for you. You decided to become a founder. Let me give you some stats in 2014 as well, right? Per capita GDP 1600. The GDP in India was at 2 trillion. We had just sort of crossed that $2 trillion mark. 7.4% growth rate. So obviously we were much better than where we started. And the Sensex was in the 25,000s. So there was obviously a lot more wealth creation happening. People were now aware of this equity class, as they call it. Were they aware of startups? Not so much, but equity class was taking off. And you began your journey as a founder. And you were trying to help IFAs better serve family offices, right?
Yes.
Right. And because Bridgemont Advisors Private Limited, and I'm just taking this from your LinkedIn page, by the way. It says, what is Bridgemont? It says Citadel, which I'm guessing is a product.
Was the earlier name of Bridgemont.
Okay. So is an open architecture advisory platform on the lines of private bank being built for the benefit of independent wealth management practitioners, IFAs, and self-directed investors. Citadel will bring client-friendly advisory processes, products, tools, and techniques that shall help IFAs jumpstart their capabilities and service levels. Citadel's goal is to complement the client-centric IFAs to be competitive enough to serve private banking clients as a principal advisor or as a family office administrator. With the help of cutting-edge technology, Citadel will also assist self-directed retail clients manage their wealth. What it is, right, was that you were preempting the growth of family offices in many ways. 2014, there was probably 10 family offices. Narayan Murthy's catamaran was one, possibly, Mohandas Pies. So family office was not a very known word. But for you to then launch a venture saying, hey, I'm a founder, I have to think 10 years out, right? You literally were trying to solve a problem you saw was coming, but may not have been existent at the time. What was that problem?
The problem that I was trying to solve, if I could be honest about it, is solving the problem around trust deficit. Over the last 3 decades, or some portion that I was actively participating, I continue to notice that everybody were watching each other in this game. Typically, there are 3 principal constituents. There is client, there is the intermediation channel, and there is an institution which creates the proposition. In a typical brand, like let's say take any company, all 3 are linear in the sense there is a proposition that an institution wants to offer to the clients, but it does so through the intermediation channel, which is usually captive channels, which is their own employees, to reach out to the clients. Since no MD can tackle all the clients and do the best of advisory, he puts in various mechanisms to do the transmission. Over a period of time, the clients themselves have also become pretty savvy, and as the relationship managers keep changing the jobs, you have left behind a client who's well educated, well informed, but the incumbent who's taking up the job was not necessarily as good as the client has evolved into. Over a period of time, as clients became wealthy, he had to start depending on himself much more.
That makes
and
sense.
There comes a critical time where the number of relationships that he has opened up over the decades are something that he would like to narrow down, think through, and have some mechanism within his offices where he doesn't need to go through the trust deficit bridging exercise. That means who does he implicitly can count on?
Yeah.
That's where I believe family offices started, and at a point where they could afford that intelligence to reside in their own premises and help them engage with all the multi-pronged relationship that they opened up and accumulated over the decades, is where I thought the family offices will need enough number of people. But for a family office to house all parts of what it takes to run this, aggregation of accounts, aggregation of advice, ability to become a quasi fund manager yourself, ability to become a wealth manager yourself, all rolled into one, will also mean that an experienced person alone can graduate from being on the sell side to a client, which is like a wealth manager, to the buy side on the client side. And very few wealth managers have that holistic experience to become the insiders to the client at their premises and at their offices, probably exclusively working for them. So since it's very complex, we thought we could crack it by converting the problem into graduating the talent pool on one hand and giving them the tools and techniques that such that they will be able to become a multi-family office. That means offer the family office services to a select few clients. So it needed a lot of thinking to become the best of being a wealth manager, sometimes being an asset manager, sometimes becoming a client who can do due diligence, or an advisor who can do due diligence on multiple incoming products, and then start changing the orientation through all these tools and awareness from a client's perspective by sitting on his side and being an unconflicted participant in the equation. That's what I thought was a great way to let people with various degrees of wealth management experience eventually graduate to become a family office to every client, irrespective of the size. Typically today, family offices today, you probably would need $15-20 million or more.
Correct.
To be able to demand that service from a wealth manager, and so on and so forth. That I didn't feel that needs to be only with a very, very wealthy client. Even a HNI who has multiple relationships can afford a family office if only the process was simplified and automated.
That getting said, Srikanth, I think what you're saying today, this definition makes it a lot easier, right? Because everything is now connected online. 2014, we were in a world where checks were the way to do business. Physical forms had to be signed. KYC was a pain. Most people didn't even have a bank account, right? If you think about how many bank accounts have been opened in the last, and people didn't have a demat account, right? And in that world where physical shares and all this stuff is happening, even real estate records were not digitized, right? All of that is, even now it is not completed in India, but it's happening. In that world, what you were talking about, to connect all of this into a platform would have to be some incredible piece of software writing, because most banks even today, I don't think are ready for the kind of hyperconnectedness that is required.
From a design perspective, I had the blueprint, but it also needed the marketplace to offer solutions. Correct. To stitch them together incrementally. My thesis was that 80 to 90% of all wealth management advisory follow some common rules. It is the last 10% which is subjective. So can I identify those best practices, common rules, learnings and wisdom from decades of experience from global wealth outfits, global fund managers, and automate the process such that anybody with average to good experience and great to good intent can automatically deliver the best advice. So that 80 to 90% is what I wanted to automate, which will require financial planning, asset allocation, model portfolio creation, fund selections or security selections, etc. That part, the science part of it is what I wanted to codify. And to that extent, it didn't require so much of integration right away, but it could wait to fill in those gaps as solutions like account aggregation, etc., fell into place. Unfortunately, even to this day, account aggregation is not a reality.
Absolutely. And in fact, I was just talking about this at an event just a couple of days back, that although reporting has become probably easier because the flow of information to the intermediaries like yourself has become much, much better. And we're probably leading the world. I think we're not one of the
we're jump starting for sure.
Yeah. But it continues to be a problem because the data is never going to be structured, especially with so many financial products. And now India, this whole derivative movement that has happened, right? It's not very easy to report all of these things. But you were trying to solve this when this was even more difficult. So
it was backbreaking, I could say.
Yeah.
Sometimes what you know for sure, you can't even articulate well enough.
Absolutely. And I think many of the founders, including myself, sort of preempt the market, and we don't realize how unprepared the market is for what we see the right thing is.
Yes, I think I was unprepared for the readiness of the market too, in the sense that you need to know when to launch a particular product in time so that it attains the critical mass.
But you were at it for 7 years.
Yes.
Yeah. That must have been that. And did you raise any money, any external capital?
My original thesis was that for this kind of innovation to sustain and the time frames of which is not known to you, you can't take public money and be held responsible for the outcomes that get associated with those investments. So I said, first, let me put my own house. Practically, it was my house that I borrowed against.
Oh wow, really? That was wow. Against your own house?
Yeah,
loan against property.
So literally betting the house. So for 7 years, we did a lot of innovation thanks to the excellent team who were very young, open-minded, and were willing to experiment. It was almost like a lab. So we had to keep the kitchen running by some revenue that came from a host of unplanned use cases of the platform that I was building in, whereas the focus was continuing to do something for bridging this trust deficit. So it was very, very tough for 7 years, but it was very, very...
And that's interesting how we met, actually. A common connect made us catch up about Bridgemont, and we had a conversation about what you were trying to do. It was very... And I told you, I think with the conversation we had was like, this is very much futuristic.
It was.
But because I myself was an angel investor, I wasn't a fund manager yet, but I was very much an angel investor and deploying some family wealth. I just thought it was far ahead of its time. Maybe today, if you pitch the same exact idea, and we'll talk about how you have, right? It would be an anti-portfolio conversation for me.
Yeah. So for the exact reason that you would have thought it is too futuristic, I too thought so, which was one of the reasons why we didn't raise funds too earlier on. And it was closer to 2019 that we hit a critical size where we thought we could explore.
So I'm going to ask you a bit more of a personal question, right? And this is purely from the intent that, and maybe a blind spot for many of us as investors. You spent 16 years in very much structured businesses, right? Citibank, HSBC, even Motilal Oswal to many extent is an institution today, right? And by the time you exited Motilal, it was a proper financial institution, it's a known name. And then you start your challenge as an entrepreneur, right? Now, everything that was a given as far as infrastructure is concerned in such large corporations is not available to you anymore. You were and sometimes I felt when I've hired, because I myself never actually worked for a large institution. I've only had effectively two jobs in my entire life, right? And both of them were unstructured startups that became big. In your situation, did you ever wake up one morning, you're like, oh, can someone get me my coffee? And you're like, wait, I have to stand up and get my own coffee because I'm no longer at Motilal Oswal or HSBC where I have a secretary, I have all this infrastructure that gets me through or makes me hyper productive in a day.
So if your question was, did it, what are the challenges in
In that
migration
transfer,
from
yeah,
forward?
absolutely. Go from like, CEO of a Motilal Oswal, structure hai, obviously there is a brand name, a lot of things they've done, to then becoming a founder and then having to recreate that magic with your own brand, right?
So I would like to thank all the firms that I worked earlier because all of them for me, were startups. When I was in ICICI Capital, uh, this was in late 90s, mutual funds were not even a product line that was acceptable to clients. And we were to understand mutual funds ourselves, find customers for it, and then build business. So to that extent, while you had a physical infrastructure and a brand to make the conversations easier, everything else was entrepreneurial. Same was the case with my stint at Citibank. You had a customer base, but the journey to make them customers also for wealth management was practically only a third solved thanks to the infrastructure provided. Job after job, the running theme is that I had practically been a recipient of only a partial readiness of the platform to make my journey easier.
Sort of an entrepreneur within a larger setup.
Absolutely. So therefore it became natural for me to say whatever may be the challenges, you've been doing it in some shape or the other, and what you could get to do was far more valuable than what you may leave behind. So it was not much of a tough decision, and having taken those decisions, it was easy to live through them too. So coffee cup, mugs, or calling up a client, nothing was a deterrent.
But do you just coming back to saying to somebody who's now transitioning over from, let's say, a large bank, right? And we've had many people who are now applying to, let's say, work at Artha, and they're coming from large brands, right? One of the first questions I ask them, do you realize that we don't have all the perks that you would get in a large brand? What would your advice to be to them that want to transition from, and it's exciting, let's not get it wrong, it's exciting to be part of the whole startup ecosystem, to go from, very structured organization. There are perks there, but there's definitely perks here too. What do you think your advice would be to them, to when they make the transition, that what should they be prepared for?
I think first I would advise people who are sitting in our chair to create an environment where whatever you want to transmit to them, the challenges of entrepreneurship, if you would like to put it that way, can be simulated. For example, if somebody comes afresh, instead of getting to expect them to start, like a plug and play kind of migration, maybe if you can create a 2 to 3 month program,
I see.
where you say, if you are sitting in my shoes, how should you be thinking? The minute some youngster is made to sit in your shoes, do rotation from all the functions, by end of the 3-month period or 2 months, he knows what it takes and where you come from and where all the layers of management come from, to finally say, this is my role, which is very critical to the firm. Having now understood how the firm is supposed to function, how it is functioning, and the interlinkages of various people's contribution, that orientation probably will last them a lifetime with you. This is first my advice to ourselves, and because of our own pressure, sometimes we don't get to invest that kind of a quality time with people who are very bright coming onto our side or who trust us to make careers for them. We probably do very little functional role only for that specific thing that they're likely to, build as an understanding around their immediate, environment. But can a broader one be a purposeful exposure that we can build for them? I would think so. That's been my regret over the years.
Very, very deep thought in that, actually, in terms of like, how do you integrate somebody coming from a very structured mindset? I always go back and we'll talk about, because Matrix is going to be coming in the next part of the conversation. But when Neo finally comes out of the Matrix, that first shock that he gets, that I'm no longer living that the dream. I felt that with a lot of individuals that were hired from very structured setup. And maybe not as high up the totem pole as you were, but even the mid-level management, right? Sometimes it just feels like they feel that they're completely out of water, right? Because suddenly they've gone from a very structured role, like you said, I'm supposed to only do this, this, and this, to now you're working for a startup. You're like, no, this is the primary role, but guess what? 20% of your role is also to look a little bit wider and say, how else can I solve these problems?
Yes.
So, and then you had a small stint after Bridgemont, right? And was there a difficult decision to say, hey, I need to probably rethink my...
It was a very, very difficult and painful decision. Considering that the utopian world that I was imagining, for which the confluence between knowledge, technology, and practice can all be done through a platform, like you said, and I agree, it was way ahead of time. It's still not
I agree.
ready for its unfolding even today. There are lots of missing pieces. But there came a point of time that the use cases that developed for the platform that I did took me far away from my original plan.
I see.
Okay. For example, we wanted to be a platform for typically wealth managers who are working in banks and institutions and wanted to set up their own private wealth outfits and also graduate to become family offices. Only a portion of the independent wealth managers who
When you say family offices, like a multi-family office.
Multi-family offices. Okay. Multi-family offices. And yes, if a family office only wanted the Bridgemont platform as a service too, I had to make it as good as that too. So this accordion kind of a tech framework crunched, it became a retail, financial planning asset allocation model. Expanded, it becomes a full stack financial service, family office model. So that was the way I built it. But more and more opportunities did come from nothing to do with the way it was built, but more to do with the way institution wanted a customized version of that.
I see.
So the migration choice was, do I become really a platform as a service or a wealth management platform? I had a hard time for the first 3 years when every person to whom I spoke to, if they said, you're a wealth tech firm, now it's a popular, acceptable term. But I said, no, I'm a wealth management advisory firm, which is using technology as an enablement. No. The reverse argument is, no, you are large. Every time you're speaking about tech. Okay, if you say so, then I'm a wealth tech firm. So you get pushed to positioning as the market will determine what it wants to take out of what you created. And that meant significant changes in my platform, and it required a lot more capital after the good 6-7 years that I had already spent. So you had now a choice to say, would I want to focus on business or raise the capital and be responsible for shareholder engagement, which is a very, very difficult job.
True.
Which, there was a fork in the road. I said, 7 years you've done it. Let me at least solve the capital problem so that I can focus on really scaling up the business, which I thought that institutions in the marketplace were kind of halfway through in accepting what I could offer. So that was the decision at which I wanted to either raise the capital or look for sources of capital. And Nitin Jain, an old friend of mine, a peer from the industry, who was running wealth management at Edelweiss on a much, much, much larger scale. We continued to collaborate as competitors in the earlier avatars when I was a CEO at Motilal. And we had such a good rapport.
And Nitin had been a career Edelweiss.
And an exceptional confluence between being a great mind and great heart. Rare combination, I would say. So it was easier for me to share my challenges with him and, brainstorm. And that's when we solved the problem, saying that if I was willing to develop that orientation to financial services through a confluence of platform, advisory, and tech, can it be done in a Edelweiss kind of environment where at least the source of capital is no longer an issue for me. It was more focused on business side. That's when we took a call saying that, okay, we'll merge the practice with Edelweiss.
Oh, so you merged Bridgemont into Edelweiss.
Not as a firm, but at least the practice, the like knowledge transfers, everything.
And you were there for about a year.
Less than that, actually.
Yeah. And then you said second innings, right?
Yeah.
So it was like a lunch break between...
No, it was like as fast as revolving doors, literally.
Achha.
I remember as I joined Edelweiss, it was in the second wave of COVID. I practically had to imagine the firm, its evolution, its journey, its ethos, principles, where the talent was warehoused, who's interconnected to whom, everything through my application of right brain more than any visual, touch and feel,
right.
Of anything. So in that period, Nitin threw a challenge saying in the 100 days, from now, I would like you to do at least 2 applications. So that was the fastest way to learn everything about the firm. And I think we made excellent progress. But within those 100 days, a lot changed in the firm, which threw up a big question whether we could do something for the rest of our careers on our own.
I see.
And then the next few months was a migration towards that decision.
And that second innings and how, right? So let me first tell you 2022 is when, 2022, sorry.
Yeah.
So was when you started Neo Wealth and Asset Management, right? And I think there are multiple companies. Will come to that. But just to give you some perspective where the country had reached by that time, per capita GDP was $2410. GDP was at 3.38 trillion, 7.2% growth rate. So a large economy now, obviously a significantly large economy and growing very fast. In fact, if you count 7% of 3.38 trillion, we had grown 300 billion roughly in a year, which is equal to the GDP at when you started, right? And the Sensex was in the 60,000s by the time you began your second innings. Now, most founders, right, after 7 years, okay, and obviously you've heard so many no's, and you sort of reference that so many no's, ki, it's too early, this would have said, let me scale back and do something small or go back to what I know. You decided I have to step up and go grander, bigger, and faster, and meaner, and brutaler. Let's put all the adjectives that we can, right? And Neo is, by the way, also our neighbor, right? Because we're sandwiched between two massively awesome Neo offices. And you decided to start Neo, right? Which I'm guessing comes from the word new.
Yes.
Because many people thought it comes from Matrix, but
it does.
It does come from Matrix too.
It does come from a conversation that Nitin had with Varun, another co-founder of Neo. It came from those conversations, and it also combined with trying to do something new and afresh.
So you're saying that you were trying to get the client out of the matrix, and we'll talk about that. But let's talk about the co-founders: Varun Bajpai, Nitin Jain, Puneet Jain, Hemant Daga. How did you meet all of them?
So most of, while I've been a brief colleague to all of these excellent gentlemen at Edelweiss, they have worked together for nearly 17 years.
Achha.
Nitin, Hemant and Varun were, and Puneet were at Edelweiss much before even I came in. And I was the fifth man who came into the fold to understand the cultural leanings and the friendships that could exist and the collective effort that we could all put together. And that's how we formed. So they knew each other. Achha. I knew Nitin, and we all got to know each other. Hemant also, I had a prior, a relationship for over 10 years plus.
So interesting mix, right? They got 4 people that know each other for 17 years. You've been a competitor to them for most of your life. And said, listen, let's just solve this problem together. And that comes to my question: what is the problem that Neo is trying to solve?
So I think we still feel that we're trying to solve the problem in multiple ways. But at least what we're trying to solve, what joins us at the hip is: does India have alignment between the people who need a financial services, people who are ready to deliver that financial service as a medium, and the people who can make enablement and support services for those intermediation channel. So this alignment between the client, a relationship manager, for example, as an intermediation channel, and the institution which provides the enablement, I think despite our best efforts, it was not aligned, in the country over the last 2.5 decades, largely because there was nothing like wealth management to begin with.
I see.
It was people making financial investment choices through friends and family, through our own experience, through the hereditary knowledge from ancient times, where most of it was either real estate or gold. And when banks were becoming reliable source, there was deposits. Once in a while, when people wanted to move away from banks, I'm talking of till late 90s, there were always accidents in the capital markets, etc.
Correct.
So there was 3 steps forward and 5 steps back in terms of their ability to move beyond how they saved. Thereafter, when the number of people who could invest in spreading the message of alternative investing. When I say alternative investing, it is very different from the way we define alternative investing today.
Correct.
So 25 years back, anything outside of deposits, I would say it is alternative investing.
Very true.
So
then for a while, real estate. Anything out of that.
So you had to introduce a holistic learning, and largely the large contributors of the holistic learning also were MNCs. So there was sometimes opportunity, sometimes a market cycle, sometimes the interest of the bank to spread over, but all of it was never at the same premeditated, it's not coming out from a business plan where wealth management was an core part of any firm. It was at the fringes as an add-on services that it started. So year after year, when people went on to improvise, and started to see the benefits of proper planning, proper asset allocation, proper investing, of which real estate was a solution. So was gold. So was deposits. Slowly, wealth management became center stage of thinking in quite a lot of institutions. But simply because of it's being a low margin business and sometimes cyclical, two decades back to a decade became very cyclical opportunity. Still, it was coming to the center and then being pushed to the fringes. It's only in the last 10 years that 10, 15 years, I would say, wealth management has become the core. Now, we all have grown over 25 years with around 30 lakh crores of, let's say, mutual fund assets, etc. It is a success. But still, why is everyone looking over each other's shoulder? The client is looking over the banks and wealth manager's shoulder. The wealth manager is looking over the shoulder saying, will my client support all through my life if I'm oriented to him? Is it the institution with support? Everybody is looking at this. We want to solve that alignment. That was one problem statement. The second problem statement is since the founders have outstanding investing capability.
Correct.
We also wanted to bring out solutions which are very, very transparent and cost efficient. Okay. So as an advisor, we want to be aligned. As a manufacturer, we want to be cost efficient and transparent and show outstanding value add to the client. And only based on the outstanding value add can we expect our business to grow.
True.
And our revenues, profitability to grow. So these were the problem that we were trying to solve. Alignment, transparency, cost efficiency.
So in that sense, if I had to ask you very simply, and we've had a couple of conversations about this as well, who really is your customer? Right? Are you solving and I believe that it's not always the person paying you who's your customer. It's who you're solving the problem for. So are you solving the problem for IFAs, who you're also, I think, considering as micro entrepreneurs in some way, right? Or are you solving the problem for the guy that is, or not the guy, but the person that has the wealth? So are you solving the problem for the wealth manager or the wealth creator? Primarily.
We are, Neo Group has multiple, divisions, multiple businesses, verticals, themes, if I could call it interchangeably. So there are different constituents for each of the vertical. If it was a family office, Neo family office, we are trying to solve the problem of the ultra wealthy clients in the country who have a lot at stake, as finances typically represents the cumulative sacrifices that the family has made. Outcome of various entrepreneurial efforts that they made, and there comes a stage where they would like to optimize how the journey should be and get the best of both risk and reward and transparency and continuity of the wealth across generations. The needs of the ultra wealthy are very different than other clients who are yet to reach the stage.
True.
So that vertical solves the problems of the clients, ultra HNI clients and ultra wealthy clients, by sitting on their side as family offices. Then comes the our own ability and inclination to be crunching all of this in some way and offering as a service that can be consumed by the end client on their own. So technology becomes a great conduit.
True.
Okay. Can we therefore collapse the accordion and make it bite-sized wealth management that can be consumed by a individual client, on their own, but through the collective intelligence represented in that, tech stack is what we are taking as a route towards the retail customer. Then there are customers who are in between. Now we have multiple options. Either we can do it the traditional way, or we can do it the traditional way, but also the alternate way of engaging with the end client. Towards the alternate way of engaging with the end client, the HNIs and probably ultra HNIs, if not all family offices, Neo Wealth Partners has also been created as a subsidiary.
I see.
Where people with experience who desire to offer the services practically as if it's their own
money,
their own entrepreneurship of advisory to the end client, and wanted to put their signature on how they service the client based on their understanding of clients, but also would require everything that a true blue wealth outfit will look like in terms of capabilities.
Why does it sound a lot like what Bridgemont was doing?
So it is true partially. Out of Bridgemont's multiple models, the one that I want to do with private bankers is the continuity of the journey that I'm currently committed to. And in this journey, the tweak has been, earlier it was a platform as a service with some additional investing capabilities and etc. Here it is like private wealth outfit with entrepreneurship inside. So we spun around the whole problem statement is saying that I wanted to offer independent advisory to go to the clients and make the wealth manager not aligned to the institution, in an obligatory manner, but aligned to the client.
Correct.
Exclusively. He should be aligned to the institution for governance, IPS adherence and portfolio performance, since that is the thing that the client expects, regulator expects. To that extent, he's fully aligned as a nearly like an employee, but his obligation now has to be only towards a client. So we had to change the model within private wealth outfits and what Bridgemont did, and bring a confluence of both. That's what Neo Wealth Partners has become now.
Very, very interesting. But when we were talking about it, Srikanth, and you said, don't take away my fire on this. But let me just, today we live in a world, right, where in many ways a wealth manager is to wealth what sometimes, because you can get advice on YouTube for free, right? You get people on Twitter who post, and now obviously SEBI is cracking down on it, thankfully, but who post things like, you can invest in certain options and they can make some millions and billions. I don't know. None of those numbers to me look real, because options is, like the late Rakesh Jhunjhunwala ji once said, right, that the person who sells option loses his house, and the person who buys options loses his bank account, right? So, but in many ways, people, are giving such free financial advice. And because our stock market has been on this incredible run, everybody's right, in some way or the other. And there's a recency bias, because, every year the Sensex is up right now 25% year on year. Since you started, we've gone from almost 60,000 to 75,000 odd and come back to 69, 70,000. So everyone's made money. Everybody's saying do SME IPOs. Don't worry about, just apply for the IPO, and there's
a rising tide lifts all the boats.
Absolutely. And in that you're saying, I'm going to give you wealth management advisory, which I can get for free. And we talked about, in a very tongue-in-cheek manner, it's like, people that go to the doctor having read on WebMD what they have wrong with them, and already telling the doctor what is wrong with them. Okay. Right? In that world, how do you differentiate and say, listen, this is not what wealth management is. Wealth management is not about investing only. There's a way more than what you have to do. It's not just about the action. It's also about the inaction that is not seen.
So I would try and use a simple example. Let's say we have 100 people in the room, and they come from 100 different families. They all are day in and day out having something at home. This is an output from somebody like a mother or a spouse cooking. So while all of us have enjoyed the food at home, how many people can actually cook?
Probably 30%, 40% maybe.
I would hazard it to be much lower.
Acha.
Cook in the sense, cook in private, grimace in private is not what I'm speaking.
Okay.
Cook in public. Also give the food in public and
expect people to probably less than 5%. Okay.
So less than 5%. So, but how do you, the number of people who attempted to cook probably was closer to where you said 30 to 40%. But the number of people who say, this is my passion, I want to stay, is again shrunk back. So this journey is what happens to investing, where the threshold of trying is very, very small. For example, if people wanted to buy a stock, it's a single stock, a few hundred rupees maybe, a mutual fund, 500 rupees. Your ability to just say, I can take control of my finances, can start with as little money as possible, the downside of which you don't really have much to lose for trying. But along the way, if you think it is not going right, but it is falling under the ambit of my learning curve, you still give yourself more chance and back it up with more money. There comes a point of time where the decisions you've taken, you start saying, was it worth my time and effort? Did I do it the best? Or were there other choices that I missed? Or if I relied on somebody, could the whole process and the outcome have been significantly better? That's when a client becomes a wealth management client, when he realizes that the total body of knowledge he has to have, the processes which leads him to the best practices, and most stable outcome that he can rely on, so that he can enjoy the fruits of his savings rather than also having to manage the savings and then once again work hard. That journey is when the client is becoming ready to seek services. And it is similar to somebody taking a paracetamol when the first rush of fever comes in, to say something is wrong, I need now to go to a doctor. So, initially people...
And not read WebMD that, oh no, this could be early signs of cancer.
Yeah. So it's the same way where wealth management. So people will go through their experience to know when to need help. The YouTube and easy dissemination is also very low barrier entry, similar to cooking. You try to read a book, let's say 20 years back there are excellent people who wrote nice books, but it never worked out in the kitchen. Somehow the taste that you imagine when you read a book didn't translate into the actual taste when you exactly follow the same steps. True. Something was amiss. Once people to start to realize that there was something amiss and they have exhausted taking things into the hands, or they realize early on it's better to do it with somebody, is the stage when wealth managers are required. And then when a wealth manager appears on the horizon who's trustworthy, the relationship takes off.
Wow. And I think it's fair to say that it's also not as easy as it's made out to be, right? Because a lot of the times you can get advice on when to buy something, but you may not get the right advice when to sell something or when to just hold on to things. And when you're on this incredible incline of a market, which we're seeing today, there's gonna be a time when the Sensex is going to drop 10%, it's going to drop 20%, right? And there's going to be geopolitical issues, there's going to be liquidity issues, inflation. It's a cycle. It's going to happen once in 10 years. You're going to get a 2008 event. We had a 2020 event, and it's going to come back by 2030. There's going to be something that's going to come. Now, I feel the job of an advisor is at that time to say that don't sell, right? But in many ways, we are our own worst enemy, right? And I remember Udayan Mukherjee was very popular anchor on CNBC, right? And he said it best. Everybody is a long-term investor in India till the market drops 5%, and then everybody becomes a trader and sells, right? Forgetting that, I had invested for, 5, 10, 20, 25 years kind of models. How do you inculcate that into a client?
Through a dialogue. If God is kind and the wealth manager gets the right format of being able to earn the trust of the client, so that whatever he has got to share will at least be neutrally taken to the client through a dialogue, through a transmission of the theoretical knowledge that he has understood and the practical examples he has understood from his own experience. As he educates the client is able to visualize the 40 more possibilities than the 4 that he has been exposed to. So when he's able to visualize that, and when events unfold and you're able to draw the connectedness of events that he was aware of,
Correct.
One of which or two of which is unfolding, that's when the relationship gets stronger and you're able to make the client stick to the original plan. So through the gyrations of markets, temptations, and other innovative solutions, so on and so forth, a dialogue with the client, a transmission of knowledge, and in an environment where you have been coming across as a very trustworthy person, allows that knowledge to become a...
But now let's be honest, Srikanth, you can't personally talk to every single client.
Yeah.
Right? Which means you have to rely on the team that you're going to create.
Yes.
And the first thing you then have to do, if you want my personal experience with at least most brands is that if you want your nth employee or nth team member to communicate a certain experience to the client, then you also need to provide the similar experience to them.
Yes.
Internally.
Yes.
And that means culture. Yes. How are you and obviously because I have Neo as neighbors on both sides, I have a bit of an insight, maybe a bit of a cheat sheet of what you're doing, but I just want to understand, how are you inculcating that level of trust and service, which comes very clearly from the conversation we're having, into your people so that they give the same experience out to the customer?
So firstly, this is, like I said, the alignment. And whatever will help you with that alignment is what the entire industry is struggling.
And by the way, I'll just
so
make it clear, when you walk into Neo's office, the first thing you find is a ping pong table before the reception.
Yes.
Right? And there's people playing ping pong. Almost every time I've been there, there's somebody playing ping pong. And there are intense matches going on, right? And so there is a very lively culture, very open office format. I think only certain areas have to be cordoned off because of regulation. But
yes.
Other than that, very open office format, very noisy. There's always something going on. There's just a lot of energy there. And so I've seen conference rooms where people are working and there's literally, I don't even think there is room to swivel a chair, right? So it's a very high productivity environment. And that's what I want to understand. How are you inculcating that in this kind of a thing?
I would like to credit a lot of it to the founding team and especially Nitin Jain. Like I said, he's one of the greatest confluence of both mind and heart. He's an IIT-IM, been a CEO for multiple businesses within Edelweiss and went on to become greatest aggregator in financial services. So his observant nature and his openness with the founders of who we should become has been the start of thinking about what kind of a culture we should have. A few things that we all go by and a lot more that needs to come along there. One is openness. Ability to allow communication from all the sources. Ability to step back and say what is right, what is not right. what is practical and what is impractical, and when do we take what steps, and so on and so forth. So if I were to put all those things and variations of that in how we apply on a day-to-day, we have firstly chosen which businesses and styles we will not be. Okay. Only where we can walk the talk, we are opening up our flanks. In the asset management side, we are very clear that we will be able to transmit our principles of unbiased advice, transparency, and cost efficiency on the back of excellent track record that we have built over decades is something that we can continue to deliver and keep improvising. We've opened that flank. Cut to chase, we are at about 5,000 crores of assets under management,
Wow.
which makes it on the credit and fixed income side probably one of the largest already in the country. I would like to thank our clients, our teams, and also the asset management capabilities. Similarly, on the family offices side, with just less than 30 families, but with four, excellent, outstanding professionals who can deliver that buy-side service to the clients, we've reached close to 25,000 crores.
Wow.
Similarly, on the new wealth partners, only 20 people out of the thousands that exist in the country have been selected to be a practitioner of their signature wealth management services to the end clients, but within the objectives that the client can theoretical and practical can have, on which we have an oversight. So we're picking apart, we are like only battles we are sure to win, we are picking them, and those we are giving it everything to make it happen. So the transmission of a philosophy, the openness culture to have a two-way communication, the efforts that we put and have an oversight on, there is near seamlessness in transmission. To this extent, we are not picking up all areas of financial services. One day we may be able to extend this, and become like a full stack financial services. But today the business that we are able to pick in is where we don't see any loss in transmission or a minimal loss in transition.
And so, but you would not be called an RIA in that sense.
So client may allow us to engage in advisory services or wealth management services used interchangeably in the client's mind. Regulator calls us very different, but the client sees all the three people as the same, but there are distinctions. When a client wants somebody to be entirely on his side, only advising him on a whole host of things, which could be brought down and boiled down into three distinct buckets: surplus management, which we now think of it as a wealth management; shortfall management in terms of raising capital, whether through debt or equity; and risk management for his estate planning.
Correct.
For his factories. You can have risk management thought of in anything that upsets the plans that the client has, both from the way he saves the money, the way he deploys his capital. It could involve even business advisory. It could be involving raising of capital. It could be family restructuring. It could be how he holds the asset. Now, this is a very complex affair, requires seasoned experienced people, and cannot have any semblance of any conflict of interest. So when a client allows us to go so deep in his thinking and wants us to be as a holistic advisor of that complexity, he treats us as a family office relationship.
Interesting.
If a client says, I want you to manage money, but without again similar conflicts, advise but don't execute, so that we eliminate any possibility of execution, or execute in a manner where you are directly dealing with the manufacturers so that there is no further layers of fees, etc. That becomes a RAA model or an advisory model. The relationship, if a client allows us to say, I'm yet to make up my mind, why don't I start out with the best of your ideas?
Correct.
Let me figure out how it fits in as proportion, timing, etc. in my scheme of things. But I'll build my relationship with one or two things that I would like to test you out, or something that you're very, very good at, or something that you're bringing to my table, which is interesting and complementing. To him, we become a distributor.
Very interesting.
So there are three approaches depending on the person serving, the elements that the client will give, and the level of engagement that the client wants.
Great. So now let's come to this, I think in many ways, and I'm very intrigued why you did this, right? Why you all did this as a group. I went through some of the balance sheets that are available via MC, and I figured that Neo has not burnt money, right? Maybe the first year that is available, there was a 10 lakh rupee profit. And then next year is almost 30 crores in revenue, barely at 1.5 crores in losses. And yet, about a year ago, I'm guessing, or about 9 months ago, you've raised $35 million from Peak XV, right? And I think there's another $15 million that is, at least as per the article, that has to come in. That's $50 million. For a business that I believe you all bootstrapped initially, there is some family offices invested into it and has not burnt money. So there's effectively almost 300, 400 crores of treasury sitting there for yourself. What was the reason to raise now that you were profitable?
So some of the businesses that like in wealth and advisory services, typically may not really need so much of capital, but a couple of areas that we need to invest for much longer time. The path of which can be an unknown.
Very
Needs to be separately funded sometimes. Sometimes it could be a certain line of services which is complementary to wealth management in terms of providing liquidity to customers who are old relationships, very critical relationships, and have a very healthy portfolio with us. Should they want liquidity against their portfolios, you need to provide that services, which can only come from an NBFC, which needs hard cash.
True.
The goodwill, intel, and investing capability or advisory capability wouldn't need that massive doses of cash. And also, as an asset manager, we people look up to us not just for our past track record, but our current skin in the game too. So, as a sponsor capital, when we grow so rapidly that didn't allow for profits to be reinvested, let's say in the asset management side, and you're still investing in people, talent, etc. So, if your next 1,000, 5,000, 10,000 crores come, you as a private equity fund manager also knows the alignment to the client that we'll have to display through sponsor capital. All these three things, and a few other things at the back of our mind in terms of investing opportunities, made us look forward to raising additional capital beyond what we were reasonably self-sufficient with.
I see. And how many people work now with or call Neo as their employer or team?
700 plus.
700 plus. Wow. And that you have 2 offices, now 3 offices at Marathon itself.
Yes.
Right. And you said offices are also in Delhi, Calcutta, Bangalore?
Delhi, Calcutta, Bangalore, Hyderabad, Goa.
Any international plans? So lots of wealth management happening in Middle East.
We will. When we get our value proposition completely stitched together, we will open up.
And usually, again, there are many people that are LPs and listening into this. What is usually the type of or the size of relationship that you believe is the right number for them to start approaching you?
So in a family office, I would say at least $75 million.
Okay. $75
million. Or
in liquid cash or overall wealth?
Investable surpluses that make it worthwhile for them to engage a highly qualified set of people to serve them. When it comes to Neo Wealth Partners, our partners choose, but with their 15-20 years of average experience and their limited bandwidth in terms of time frame, but unlimited skills that they may already have or develop. So typically they will look at least $4-5 million to start with as a relationship, so that in a month you can at least cover 20 meaningful relationships and make it worthwhile for themselves. So there they have their own choices. In family offices, we have a indicative threshold. That's how it is. When it comes to the digital wealth, that will soon unfold, and the client makes his own choices but uses the platform.
But over there also, are you targeting a certain size of user? Like, will you go to the 500 rupee mutual fund guy also?
The firm believes in democratizing great investing capabilities. I don't think there will be a certain size restriction, more in terms of how much they can capitalize on what we get to offer.
Interesting. And as a founder, and before we start the next round, which is rapid fire, right? What is the one metric that you're tracking on a daily basis that tells you whether your part of Neo or Neo as a whole is headed in the right direction or not?
So each business has different metrics. Maybe I will speak about Neo Wealth Partners.
Please.
For me, the ability to read what could be the requirement of those 3 constituents, which is the client and the intermediary and the institution, I would actually put from what the client needs, what the wealth manager needs, and what the institution needs in that sequence. Okay. So on a daily basis, I have client portfolio performance tracking is my go-to metrics on the client side. And on the wealth manager side, how they are creating the investment policy statements, how they are creating the asset allocation, etc., is what I would have to lean on my product and advisory team to track that. And from the business side, it is a cost benefit thing. Everything that you're making a rational decision about investing on one hand, the gestation periods and the break evens, and on the ongoing basis, profitability to be able to keep reinvesting is the thing that I monitor.
And do you check how often do you check the P&L for your part of the business?
I've kept things so simple that everyone's interests are so aligned that everybody guns for profitability at their end. and my need for having a super tight monitoring is not as tight as in a complex business. It typically is a once in a month exercise.
But you go through it every single month.
Yes.
It's very, very important. I think most founders, and I wanted to bring that up because I know, Srikanth, you are calculating things all the time. It's very important to go back and look at the dashboard once in a while, no matter how long the drive is, right? But you need to look down and say, hey, how much fuel do I have left? What is the speed? Which direction?
Yes.
And it's usually it's usually the simplest thing to do. But just like the annual blood test, we don't take, right? Yes. Most people don't like that. How did you like it, or did you get yourself to like it?
I had developed this. So I was not a traditional business manager to begin with. I worked my way from being a relationship manager all the way to being a CEO. And along the way, I learned these principles of creating a blueprint, creating execution trackers, see the misalignment as they develop, and find out course correction. So it was a skill that I got exposed to over a period of time. But when I started my own firm, it made the difference between life and death.
Really? Wow.
Yes, of course. Since, like I told you earlier on in the conversation, I was at my house, I still had to be answerable to my wife and kid who allowed that to happen. And I couldn't put any of us out of the house. So you have to manage the house, the business, and your own, philosophy of life.
And what were you tracking at that time?
I was tracking the bank balances, which were, it was an overdraft facility against the house.
Achha.
So I had to say, what is the likelihood of a revenue coming in, which will service the interest cost on the loan. That was my only financial parameter for almost like nearly 2 years, two and a half years.
Quite honestly, I think founders should do that even when they raise equity. Imagine the ROI, and imagine the ROI the investor wants. Is that less or more than the ROCE that you're actually getting, right? Because if your ROI expectation from the investor is higher than the ROCE, you're eventually going to lose the business, is my feeling, right? And that's what something I've learned. You always have to make sure that the ROCE is always higher than the ROI the investor wants. In this case, the bank that is the investor by giving you money. So if you are borrowing at 12%, 13%, jo bhi number hoga, and your business is generating 8%, and you're calling it growth, right? Somewhere or the other, the 6% is coming out, right? So I think that's a very, very good way to maybe have the first innings. You just imagine the debt that you're taking on. But thank you so much, Srikanth. I think at least the conversation has been incredible.
Thank you.
Your each and every word seems to be measured, and I can almost hear the engine back there calculating the next word to say. But as I do in every single show, we have to have a rapid fire, because now I want you to stop that machine and just blurt out answers.
Yes.
So we're going to do a quick rapid fire round. I've got maybe roughly about 15 questions. Maybe I'll get through 10 with you. Some questions will be fast, and some maybe lead to another little 30-second explanation. So are you ready for that?
Yes.
Okay, good. First question, right? What is the last book you read that had a profound impact on you?
Bhagavad Gita.
Bhagavad Gita. When did you read that?
So it was taught to me, so I wouldn't say it as being read. There was a time when a lot of answers were not readily available. I had to understand the game at levels that I didn't think was was a perspective that I had. That's when I sought deeper answers, and thanks to some great monks who could devote nearly 3 years to explain stanza by stanza. And it was an experiment in life. You learn something, come back, practice again, have a few more questions. So I have not read it the way you may refer to as read, but that is something that has...
And if somebody wanted to replicate the experience, where should they be going?
I would still suggest that. The same.
Like, is there a place? Is there would you go to the Chinmaya mission or?
So there are outstanding people who do it on the YouTube.
Achha.
And in fact, if anybody could learn from YouTube, they should learn Gita, and from multiple sources, so that you triangulate what you feel as the right interpretation.
So in fact, I've also gone through the Gita experience myself. I used a podcast actually on Apple. It's called the Gita for Daily Living. Okay. Fantastic experience. Again, very much like you trying to figure out.
In my case, it was the monks from ISKCON.
The monks from ISKCON. Is that the name of the channel?
The Hare Krishna movement, Adinarayana Prabhu was the one who taught me Gita.
Okay.
Yeah.
So I'll get the link from you, and I'm going to put it in the comments for anybody that would like to follow. Okay. Let's ask you this question. Work-life balance for entrepreneurs. Is that a myth or reality?
It's a myth.
Why do you say that?
Very few entrepreneurs are, ready to sacrifice what may not happen if the work doesn't creep into their personal lives. So a lot of us don't become entrepreneurs, in a well thought through manner. There is some passion that makes us ready.
Very true.
There is an effort that we put in, but the ALM mismatch between when your efforts, will fructify and the quantum of its fructification means that you are in some suspended animation. So you bring work to home even through anxieties and worries.
True.
So people who say work is different, what may happen there is just one part, and have learned that skill earlier, are the only ones who can create a balance.
And even then it's difficult.
Very difficult.
Because the crises come and then suddenly the whole work-life balance goes for a toss. Okay, what's the first action you do after waking up?
These days it's been different.
Achha.
But earlier it was my mobile.
Okay. Yeah. These days, what is it?
These days I just sit and do just a minute or two of praying.
Praying. Achha. Let's see. One question that you wish investors would ask more often.
What are the other ways to achieve what I want?
Wow. Other ways to achieve what I want. Okay. A quote or a song that motivates you on a particularly tough day.
I'm not very good with Hindi. There is this Apna Number Aayega.
Acha. It's a very good song. We'll put that in the links as well. All right.
Apna Time Aayega, was it? Apna Time.
Apna Time Aayega. The Ranveer Singh song. Yeah. Okay. What is a hobby or a talent or skill that most people would not know you possess?
So, I'm pretty much like an open book to almost all the people. But one thing that I think they don't know much about is that I try to connect the dots to a level that most people may not be aware. Okay. And it's been both my plus and also the minus.
If there was a time machine, and I believe there could be one in the next 30 years or so, and that would allow you to speak to yourself when you were 18, right? What is one piece of advice that you would give to yourself?
I would just say relax.
Relax.
It's been a very tough journey all through. It's never been, relaxation was once in a few years when you've been, when you hit a high in all fronts, work, family, finances. When that confluence happens, you're on a high, but rest of the times you're wound. So if I could go back in time and say, just chill, sab theek ho jayega.
Over a period of time, sab kuch theek ho jayega. I think that's very sage advice. It's one of the most, because I think as entrepreneurs, we just want things to happen quickly, right? But certain things just can't happen quickly. You can't, you can't make a mango tree grow faster just because you wanted it to. It will take its time, and it needs to go through the whole process of becoming a tree and then giving fruits, and that needs patience. How would you measure your life?
So I would measure my life by understanding the purpose of life and attempting to fulfill it.
And one, I think, second last question, that if you had not done wealth management, right, and this entire 26-year journey you've been on, what would you have done?
I would be a librarian.
A librarian.
I love reading books. That's the best place where you get paid to
experience.
Experience.
All right. I think last question that I have for you then. It is said that investment is a mix of art and science. Do you agree or disagree?
I would say it is mostly science.
Mostly science. But isn't that intuition that people talk about?
Intuition has led us with the statistics of only 1% of option traders make money. So much for intuition.
Isn't that itself an intuition too? Because I think it's 0.1%.
Less.
And at least the active traders maybe 1% or 10%.
They have to act. In fact, in investing, it's more about curbing one's intuition.
Yeah, working against it. So thank you so much. This was the end of Rapid Fire. Srikanth, it has been one incredible conversation. Thank you so much
for this platform to have a great fun on a Sunday.
And is there anything else you would like to say before we close for the day?
Nothing really. Just, I would think almost all of us experience lives uniquely, but what is there to experience is not so unique. So the day we figure that, that we have just about 8-10 emotions and umpty number of combinations of that. I think we will be able to understand the tapestry of the whole world, its working, and be at ease with it.
Wonderful. Thank you so much. I think it was an incredible conversation, like I said, and I think coming from this, this 26-year journey, and I think in many ways that you've done a lot of the tough stuff that was probably you could have chosen an easier way, right? But you decided to go through the tough experience. 2014 is around the time when I took my first entrepreneurial jump. And I know that it was not easy to do business in India, right?
I can only thank my wife, Leela Rani, and my son, Krishna Chaitanya, for being the pillar of support for even trying this.
And that's so important, right? I think, like you said, at the end of the day, the work-life balance, it's really the family that is doing all the balancing.
Exactly.
Right. So thank you so much, Srikanth, once again. Really appreciate the conversation. Hopefully, in about 30 or 40 episodes from now, we'll call you back and we'll go over some of the stuff we talked about today. And
happy to come back.